Hi, I'm Farrian Azim, and I'd like to thank you for tuning in to our webinar on buying your first home. So today we're going to go through the steps of what you have to do when you're looking to buy your first home. So the first thing we're going to speak about is your deposit. So the minimum deposit you need to have is 10%. So that 10% deposit, 5% of that needs to be genuine savings. So when we say genuine savings, that needs to be saved incrementally through your bank account, week by week, month by month, over a period of a minimum of 3 months, usually up to about 6 months. The other 5% can come from things like your grant, a gift, inheritance, or something like that. But most lenders need this 5% to actually have been saved. So once you've decided that you want to begin the journey of buying your first home, it's really important to know your numbers. That means sitting down with a professional and working out what is your borrowing power. How much can you afford to borrow? Different lenders have different requirements and different ways they lend, so it's really important to sit down and find out what your numbers are before you get involved in the process, because that can be your guide to how much you need to save and what level of property you need to look for. So as a first home buyer, the government has several incentives that you can utilise to purchase your first home. These are state government incentives. So the first incentive is, if you were to buy a brand new home or unit of first occupation up to the value of $750,000, you can achieve a $10,000 first home buyer grant. So that's a first home buyer grant of $10,000 if it is a brand new property. The second incentive you have is that if you bought to buy a second-hand property up to a value of $650,000, then you pay no stamp duty. So that's a saving of about $24,000. Between the price of $650 to $750, you actually have a discounted rate of stamp duty. If you were to buy a block of land less than $350,000, then you pay no stamp duty also. And between $350 to $450, there is a discounted amount of stamp duty paid. So when looking at this, when you sit down with your mortgage professional, they can actually go through all this and work out what is the best option for you. So what happens once you've got that 5% deposit saved? So once you've got that 5 to 10% deposit saved, it's time to sit down with your lending professional and actually go through and look at a pre-approval with a lender. So what will your broker or your lender ask you for? They'll ask you for pay slips, group certificates, 3 to 6 months bank statements, credit card statements, other loan statements, and living expenses. It's very important to also have an outline of what your living expenses are. So what have you been spending your money on? So once you put all that together, then your lender or your broker will actually sit down with you and go through all the different lenders that they have and who will lend you how much money. And then they will go through and they will sort out who's the best lender for you and find you the best loan that suits your needs. So what are the different types of loans? The first type of loan we have is what's called a variable loan. So what's a variable home loan? A variable home loan means the interest rate is not fixed. It can vary depending on what the Reserve Bank and the lender have got happening on that day. But a variable loan allows you to pay extra into it. It may have bells and whistles such as offset accounts, redraw available, and all those sort of things. A variable loan has a lot of flexibility. It allows you to pay more to actually pay your loan off faster. However, it is not fixed, which means that the rate will go up and down, so you don't exactly know what your repayment will be. Next type of loan we have is a fixed loan. What's a fixed loan? A fixed loan is a loan that is fixed for a period of time, whether it be 1, 2, 3, 4, 5, 7 through to 10 years. The interest rate on that loan is fixed. So just say your interest rate is 4.5% and you fix it at 3 years, That means for 3 years your rate will stay at 4.5% and you know exactly every week, fortnight, month what your repayment is. Some fixed loans do allow you to pay extra into them, but most are capped at a certain amount that you can pay. And if you break that fixed loan, as in you repay it early or you sell that property or something like that, then you would usually be up for penalties of breaking a fixed loan. These are the two types of loans that are probably most suited to first home buyers. There are several types of other loans on the market, but a variable loan or a fixed loan is the most suitable type for a first home buyer. Lender's Mortgage Insurance, or LMI. You've probably heard about it, but what is it? Lender's Mortgage Insurance is an insurance that you pay, however it protects the bank in the case of default. If you borrow anything over 80% of the value of the property, you pay LMI, Lender's Mortgage Insurance. So that allows the lender to lend you between 80 to 95% of the value of the property by paying this extra insurance. You may have heard of another option to purchase your home with no deposit. What that means is that if you have an immediate relative, such as your parents or your partner's parents, or someone immediate, and they actually have a property that they're willing to put up as a guarantor for you to buy a property. What that means is that you don't actually physically need to come up with any money. However, I still believe that you should have a minimum 5% saved so that you can actually have some home money. Because if you have never saved anything and then want to go in and buy your first house and then you have a repayment of a couple of $1,000s every month, you won't be able to cope. So how a guarantor loan works is that an immediate family member actually puts up their house as security for you to purchase a property. So say that you were buying something for $500,000. What that means is that the bank would actually lend you $500,000, the whole amount, to actually buy the property with. However, what they use as security is your parents' property, which is worth $800,000. Parents' property and your first home buyer property. So both properties are used as security for the one loan. So that means that if something happens and you don't pay your loan, the bank will sell your house, however will also be able to sell your parents' house to be able to pay back that loan. I know it sounds a bit scary and daunting, but there is an option and you can look further into that. So once you've got your deposit all saved and you've got your pre-approval done and you're really ready to go and find a property, you'll go out shopping on the weekend and one day you'll fall in love with something that you really like and that will be your dream home. So what is the process from there? So basically the agent will, there may be a where you need to put in an offer and then the vendor will come back and offer something else and then you'll go back, so there's an offer and acceptance. The agent will then probably take you back to their office and you'll sit down and you may look at a contract. We usually suggest that no one signs a contract at this stage. It's very important to have a solicitor or a conveyancer, a legal person, review that contract and make sure that all the bits and pieces that are in there benefit you and not just the vendor. So all the little clauses and things like that. So it's very important to not sign anything as soon as you find a property. I know it can be a very emotional purchase and you'll be ready to sign, but it's very important to keep your thinking hat on and just make sure you've got all those steps outlined. So the next thing that would happen is your agent will usually send the contract to your solicitor, who'll review it and then go back to the other party with maybe some changes and things like that. Usually when you put a property on hold at the agent, you'll be required to place a holding deposit. This is usually an amount of 0.25% of the purchase price. This is usually just a holding deposit. If you decide not to go through with this property, you will probably lose this amount of money, but it is a holding deposit to make sure that that property is taken off the market so that you are in the process of buying it. Once that's happened and your solicitor's reviewed the contract and you're happy with everything, then at this same time, usually your finance is being approved. We also advise everybody, do not exchange contracts and pay the 5% holding deposit until your final approval has come through. That means that the valuations have been done, or the inspections that the solicitor wants done, all these things have been done. So you are guaranteed that you are happy with what you are buying. Because once you pay that 5% deposit to the vendor and the contracts are exchanged, you are unable to get out of that contract without being up for big penalties. So as we were saying, so what would happen is once everything's going good and you're happy and your loan's approved and all those sort of things, you would then put down a 5% deposit, and that means that the property is basically yours. So by the time you put down that 5% deposit to settlement, usually most contracts will have a 42-day settlement period. 42 days means it's about 6 weeks. So from the time that you exchange to the time of settlement is usually a 6-week period. If it's maybe a brand new property or still something under construction or that property, those dates will probably go out. But usually most normal house and land contracts are 42 days. So now the time has come and you've settled on your new loan and you have a new house and a new loan. Probably a big debt of about $500,000 plus. So how are you going to manage this debt? So your broker or your lender is probably giving you an approximate repayment to pay. I would suggest that it's very important that you actually pay a little bit extra every week, fortnight or month to make sure that you're on top of that loan. What happens is when you put that little bit of extra money in your loan, it actually builds up and saves you interest. It also allows you to actually redraw that and use it just in case any unforeseen things come up. So it's very important to pay a little bit extra into your loan every week, fortnight or month. These days, a lot of loans also come with an offset facility. What that means is you have a loan here, that's your loan. You have a bank account that is actually attached to the loan. For every dollar you have in there, you actually save interest on your loan. So for the month, say you have both salaries come in there and they account to $10,000. All of a sudden now, your interest on that loan is only being calculated on $490,000. So what most people would do is spend from here and then have this money sitting in here and then accumulating, and then once you've got an amount in here, you can actually pay it across over here. However, every month your normal repayments are still going on and your loan is still amortizing or reducing a little bit. But all your excess money that you've got sitting in there is actually saving you interest as well. So once you've decided that one of your goals is to buy your first home and you've decided that you want to really save, it's very important to get together a cash flow or a budget to find out what are you spending on and where can you cut corners and save so that you can increase the deposit that you'll be able to pay on this property. Small things like eating out, buying lunches and things like that. It's very important to look at all the little things and try and save as much as you can to buy your first house. So I'd like to thank you all for tuning into our webinar today. It's very important that you look at the steps that we've outlined here and sit down with your professional. Of course, we have our own mortgage broker here at Carnes in Mortgage Choice. We have a lot of first home buyers that we have helped, and we look forward to helping a lot in the future. Now, financial planning is another very important aspect of first home buyers, as goal setting. If you really want to look at buying your first home, it's always important it's a goal, and as part of financial planning we do look at goal setting and how can we actually get you into that first home. So once again, thank you for tuning in, and you'll be sending you out an e-guide, and if you have any questions, please don't hesitate to contact us here at Mortgage Choice at Carnes. Thanks.